Hi, this is Jeff Tamburello, Director of the Southwest Florida Real Estate Investment Association. We're here to talk today about real estate markets and what factors determine whether a market is profitable or not. For full disclosure, what I'm sharing is what I do for me. Please feel free to share any thoughts, comments, rants, observations. This is really geared towards a sub-market approach within a market you already know. First, define why you enter a market. Are you entering it for cash flow? Are you entering it for price gains? Are you a real estate professional, a vendor? Are you trying to buy and flip? What is your targeted rate of return? It's huge. If you don't understand your business model, you're likely to wander into a minefield. And you always have to focus on what sector of the market are you trying to enter and what sector of the market are you trying to serve. Should I or shouldn't I? It's a really big question. Not all markets are created the same. Before spending time and precious money, and more importantly, time on a market, do some homework. And here are some factors that I use to determine a market's suitability. I look at number of sales. I look at the amount of money in motion. I look at the average sale, the median sale, and I also look at the price per square foot. I generally build a history of each trend. I like to go back all the way to the beginning of the last cycle, all the way through the bust, and then all the way up through the beginning of this one to try and understand where you're at. Now bear in mind I live in Southwest Florida, which is a boom-bust coastal market. It's what it is, it's what it always will be. So I'm always trying to determine where I'm at in the cycle and where the last cycle took us, not as where it's going for sure, but it gives you some overlays so you can try and make some calculated guesses. The key to data is garbage in, garbage out. Scrub your data. Okay, data will never be perfect, but take every 10 sales in your database and verify them against public records. Make sure they're right. The best tool to do this with is Microsoft Excel. That's what I use to analyze everything from foreclosures to sales to my garden. I use Microsoft Excel for everything. Number of sales. Okay, there's some questions to ask. Are the numbers trending upward or downward? Do the sales follow a pattern, either by the month, by the week, by the quarter? Is it seasonal? Okay, and then also bear in mind, take the number of sales in. Like in Lee County, Florida, 3% of the market share is a huge share of the market. On an average month, there's 1,500 sales of recent. 3% of that for one person is a pretty good amount of business. Okay, and the number of sales are going to determine whether you want to gain entry into a market. If there's 4 sales within a given sub-market every month, you only have a 25% chance of pulling one off. Those aren't very good odds. Here's a chart we did back from '08 of Cape Coral residential sales. Kind of gives you the way our market bounces up and down. And you pretty much January the snowbirds get here, they start figuring out. February a couple buy, March a few buy, April some more buy, and then it goes and goes and goes. Amount of money in motion. You really need to know this because it's really the true market maker. There's guys that are flipping packages of 50 and 100 houses out of like areas like Detroit and Flint and Cleveland, but 50 houses sold at $1,000 each for $50,000. That's a lot of work. You have to do diligence, the closing on 50 houses for $50,000 or percentage or however you're working it. Okay, to determine whether the money in motion works for you, you need to know the percentage of profit per deal you're going to make. Say you're a real estate agent, you're going to capture somewhere between 2 and 7%. On a flipper, 10 to 25%. The key is to take these percentages against the money in motion and understand that there's enough money for you to justify going into the market. Average sales. This is the average of all sales activity. It really determines where the action is. For the most part, most statistical people work with averages. They don't work with median. Real estate associations tend to like median. I like the average for my business model better, and particularly I always try and play below the average. In a declining market, you always want to play below the average. Median is basically a statistical number that sits dead in the middle of the data set. Here's a chart of Lee County, Florida, and it's got a median and an average, and it kind of gives you the how they interact. I don't really, particularly for analysis for me, I don't really look at the median or the average without both of them on the same chart, because together they give you an idea of what they're doing, and that could be a whole 2-hour dissertation on the interaction of the median and the average. Just if you have the opportunity, put both of those prices on the same chart, and you can watch them bump and pull each other around, and after a while you'll start figuring out which one pushes which one. Average price per square foot. Primarily what I use this for me, is to evaluate deals quickly. Okay, and if I know a market is trading in the $40 a square foot range and I'm looking at a deal in the $60 a square foot range, now you should never comp with price per square foot. You should always do apple to apple comps, but I do use price per square foot as a fast tool to vet a deal. Now here is using momentum within a market on the upward side or the downward side. This is some consulting work I did in end of second quarter 2008. We're looking at some Lehigh Acres homes in a big package. I was doing data work for somebody. So I actually took and I figured out a price per square foot, and I analyzed it, okay, and came up with I came up for a quarterly total and determined that trend. Now the long skinny line you're going to see is a poly trend line. We're not going to go into that because that can be another whole 2-day dissertation. But what got me was when I carried my trend line forward 2 months, actually one more quarter, it gave me an indication based upon the momentum of the market where it was going. And what was interesting is I put it on my Outlook and I went back in second quarter of 2008, and lo and behold, it was actually $1 a square foot too aggressive than where it was. But particularly in a declining market, if you're going to do a deal and say you're buying in at 118 a square foot here and you can't exit till here, if you're basing your numbers off this being, you know, your fair market value, and the market's declined into this, you're now upside down. And it's really big to understand whether you're in a flat, a declining, or an appreciating market. Now flip this over, and if you're in an appreciating market and it takes you 60 days to get a deal done, whether you're rehabbing, whether you're listing, you could actually leave quite a bit of money on the table by not understanding the momentum and the value trends of your market. Okay, some things I've learned of recent. All you can do is show what happened yesterday. Predictions are basically educated guess. Treat them as such. And again, watch the median and the average and how they interact. Now, how to determine when you really should move a market. Okay, here's some more bullet points. I look at in the following order. I look at money in motion. Is there enough money to justify me accomplishing my goals? Number of sales, that really gives the exclusivity of the market. Can I gain entry? If there's 10 million moving through a sub-market and there's only 10 sales, I would shy away from that market. If you have 500K moving through a market and 50 sales, the risk and exposure is not worth the reward. And again, I can't stress this enough, the safe money always plays under the averages. Well, we sure appreciate you watching our video. You can always email me at jeff@swflreia.com, and you can check our website out. We've got a blog at www.swflreia.com. Thank you, and make it a profitable day.